Now we're going to cover health savings accounts. This is lesson 14 in self-study guide we're following this year. You can find information on this on publication 4012. That's the NTTC modified publication 4012, tab E, in publication 4491, lesson 17, and also in publication 969 and the form 8889 instructions. Let's start by defining what a health savings account, or HSA, is. It's an account for pre-tax money that can be used to pay for qualified medical expenses. That includes co-pays, prescriptions, dental care, contacts and eyeglasses, bandages, x-rays, and a lot more. It's tax advantaged because contributions reduce a taxpayer's taxable income, and the money isn't taxed while it's in the account, even if it earns interest or investment returns. Now, we'll talk about eligibility requirements a little more in just a bit, but the owner of an HSA must have a high deductible health plan. The term high deductible health plan, or HDHP, refers to a health insurance plan with a sizable deductible for medical expenses. Now, an HDHP usually has larger annual deductible than a typical health plan, but charges lower monthly premiums. Now, the minimum deductible varies from year to year. The IRS defines an HDHP as one with a deductible of at least $1,600 for individuals and $3,200 for families in 2024. Now, we'll look at contributions in more detail, but just remember there are annual contribution limits, and the contributions can be made by an eligible individual or others. That includes an employer or other persons as a gift. Now, distributions are not taxed if they're used for qualified medical expenses, and they can only be used for expenses incurred after the HSA is established. Now, HSA contributions and distributions are reported on IRS Form 8889 and included with the tax return. Form 1099-SA provides the taxpayer with information on contributions. Form 5498-SA provides the taxpayer with information on distributions. Okay, let's explore each of these areas a little more deeply. I highlighted the term eligible individual in the prior slide. So, who is eligible to contribute to an HSA? Well, taxpayers who satisfy certain criteria. First, the account holder must have had a high deductible health plan on the first day of at least 1 month of the year, and they cannot have other health insurance or be covered by Medicare for the months they contribute. There are exceptions that can be found in IRS publication 969, and a spouse can have other coverage if they're not the HSA owner. Finally, they cannot be claimed as a dependent whether or not someone claims them. Now, if they satisfy these 3 requirements, they're considered eligible to contribute to an HSA. Eligible contributions to these accounts are not subject to income tax. Contributions are due by the due date of the return, which is generally April 15th. That's similar to an IRA, where taxpayers have additional time to contribute after the tax year ends. Contributions can be made by someone else, for example, a relative. Now, those are treated as a gift to the taxpayer and will be deductible by the taxpayer. All contributions must be in cash, no stock or property. How do we know that a taxpayer has an HSA? Well, hopefully the taxpayer notified us via the intake booklet. During the intake interview, they should have been asked whether they made any contributions or received any distributions. Check to see their W-2s to see if there's a code W in box 12. This code would indicate that an employer has made a contribution to the taxpayer's HSA. And also, check to see if they provided a Form 1099-SA for any distributions and/or Form 5498-SA for any contributions that they may have made. Contributions are often made by an employer through an employer plan. You'll see those on a W-2 in box 12. They'll have a coded W, and any contributions will automatically carry forward to Form 8889. Now, contributions on W-2 will include both the employer and the employee contributions. So if an employee has what's called a cafeteria plan at work, those will be aggregated with the employer contributions and the total will be on the W-2. Now the contributions on a W-2 count towards the taxpayer's contribution limit for the year. So any contributions on a W-2 and contributions from outside of work must be added together to be sure the contribution limit is not exceeded. Let's look at the contribution limits. They tend to go up every year. Here are the limits for several years, including the current tax year of 2024. Contribution limits are based on the type of policy, that's self-only or family, the date the taxpayer became eligible, the date the taxpayer may have ceased being eligible, and the taxpayer's age. Though individuals who are 55 or older are allowed to make an additional $1,000 catch-up contribution to their account each year. Contribution deductions are reduced by the amount of employer contributions reported on Form W-2. Now, HSA contributions are limited to the number of months a taxpayer is eligible during the tax year. Let's look at prorating allowable contributions, but remember, there are no joint HSA accounts. Partial year HSA eligibility. If taxpayer is not HSA eligible the entire year, then their contribution limit is limited to the greater of the months they were eligible, and that's the monthly eligibility determined by the first day of the month. Or their maximum contribution is based on the first day of the last month of the tax year. It's called the last month rule. So what this is, if they were eligible on the 1st of December, let's say 2023, and they were eligible for the month of December 2023, then they can claim, they can use the maximum contribution limit for 2023, the entire year, as long as they remain eligible for the entire next year. So if someone was eligible on December 1st of 2023 and claimed that month, was able to use that month, they could use the maximum limit for the year of 2023 for contributions as long as they remained eligible for the whole next year. That would be 2024. If they did not, they would have to return some of those contributions. So key in the number of eligible months. The calculation is performed by TaxSlayer. Don't worry about the calculations. We just need to key in the number of eligible months, and TaxSlayer will do the rest. Since we're discussing contributions to an HSA, here's the form where contribution information is provided by the account trustee to the taxpayer. Now you can see total contributions in box 2, rollover contribution in box 4. We're going to discuss rollover contributions in a little bit. The total account amount is in box 5. And you can see that this form is for an HSA, which is checked in box 6. Since taxpayers have until April 15th, normally, to contribute to an HSA for the prior tax year, these forms are sent out usually in May. So the taxpayer may not have received the form prior to filing their tax return. In that case, they'll just need to provide you with a number for their contributions for the prior year. The last slide of this presentation contains a link to a Tax-Aide video that covers the entry of HSA information into TaxSlayer. Now in TaxSlayer, we'll enter HSA information into the data entry area for Form 8889. Contributions are reported on this form in Part 1, which is seen on this slide. That's used to report all HSA contributions and to compute the allowable HSA deduction. Note that HSA contributions made by the taxpayer and anyone who made contributions on the taxpayer's behalf are on line 2. Employer contributions and contributions the employee made through work are entered on line 9. The deduction amount is found on line 13. Now, a big hint, there's pretty much always a question on the tax exam that deals with whose contributions are found in Part 1 of Form 8889. The answer is everyone's contributions are found in Part 1. Excess HSA contributions. Excess contributions incur an additional 6% tax until they're withdrawn or they're used as qualified contribution in later years. Now, if an additional tax applies, it's out of scope for us. Now, a quick knowledge check. True or false? Taxpayers must reduce the amount that they or any other person can contribute to their HSA by the amount of any employer contributions excluded from income and any amount they contributed pre-tax through an employer plan. These amounts, by the way, would show up on a W-2. And true or false? Angie has an HP plan and an HSA. Her mother contributed to her HSA as a birthday gift. This is an allowable contribution that Angie would report on her tax return. The taxpayers must reduce the amount that they or any other person can contribute to their HSA by the amount of any employer contributions excluded from income and any amount they contributed pre-tax through an employer plan. That's true. All of these amounts count towards the limit. And Angie has an HDHP plan and an HSA. Her mother contributed to her HSA as a birthday gift. This is allowable contribution that Angie would report on Angie's return. That is true. And another question. Svetlana has an HSA and a self-only HDHP. Her employer contributed $1,000 to her HSA. She contributed $500 through her work plan. Now, both of those, the $1,500, are reported on her W-2. She separately made another $2,000 contribution. What amount is her HSA adjustment to income on Form 1040? Well, the amount is $2,000. Her contributions through work are already pre-tax, so the $1,000 her employer contributed and the $500 that she contributed is not deductible. They've already been deducted. We've looked at HSA contributions. Now we're going to take a look at HSA distributions. Now, distributions are not taxed if they're offset by qualified medical expenses. HSA distributions can be taken at any time. There's no time or age limit, but they can only be used for expenses that were incurred after the HSA account was established. You can receive distributions from an HSA even if you're not currently eligible to have contributions made to an HSA. However, any part of a distribution that's not used to pay qualified medical expenses is includable in gross income and is subject to an additional 20% tax unless an exception applies. HSA deductions can't be used as deductions on Schedule A, so there's no double dipping. They should appear in Form 1099-SA, which is shown here. Here's a full copy of a 1099-SA for distributions from an HSA. Note the gross distribution is in Box 1. In addition, the box in Box 5 next to HSA is checked, indicating it's for an HSA. What are qualified medical expenses for an HSA? They would generally qualify the same as Schedule A medical and dental deductions, but they're not exactly the same. There are differences. So see the chart in Publication 4012 for an actual list of qualified medical expenses for an HSA. Now, it includes over-the-counter medical products and medicines. The taxpayer would not require a prescription for these. Continuing with qualified medical expenses for an HSA, I would include unreimbursed post-tax insurance coverage premiums. It could be covered under long-term care up to the deductible limit, COBRA continuation coverage, while receiving unemployment, and Medicare if the HSA account holder is 65 or older. Now, that excludes supplemental coverage like Medigap. Whose qualified medical expenses are covered? Well, the taxpayer and spouse, any dependents that may be claimed on the return, others who could have been claimed as a dependent except that the person filed a joint return, or the person failed the gross income test, or the taxpayer or spouse could be claimed as a dependent on another's return. In addition, the child of divorced or separated parents, regardless of who claims the child. And this is true whether the HDHP, the high deductible health plan, is self-only or family. With an HSA account, there can be excess distributions. This can happen when a distribution is received for medical expenses that aren't qualified. Now, these excess distributions are subject to an additional 20% tax unless the account beneficiary dies, became disabled, or turned 65. In that case, there's a box and tax layer that can be checked to avoid the 20% additional tax. Now, here's an example. Juan withdrew $2,525 from his HSA, but only incurred $2,000 of qualified medical expenses. So the difference of $525 will be treated as other income on 1040 Schedule 1. An additional tax of $105, that's 20% of $525, will be added and will be due. That's on Schedule 2. Now, mistaken distributions due to reasonable cause can be repaid by April 15th in some cases. I mentioned HSA rollovers very briefly a little earlier in the presentation. Let's talk for a minute about HSA rollovers. Now, just like an IRA, you can move money from one HSA custodian to a new HSA custodian. An HSA rollover contribution is not included in income. It's not deductible. It doesn't reduce the contribution limit. Now, a taxpayer does not need to have HDHP health coverage to move an HSA account to a new custodian. It must be rolled over within 60 days of receiving the funds. Only one rollover can be executed per 1 year period. That's not calendar year. It's a 1 year period. So if it's provided to the taxpayer on June 1st, you can only do one until June 1st of the next year. HSA rollovers are reported by the taxpayer on Form 8889 in Part 2. It'll also appear on the 1099 essay as part of total distributions and should ultimately be reported in Form 5498 essay by the receiving custodian. Now, please note that if the taxpayer instructs the HSA custodian to send the rollover funds directly to the new custodian without touching the funds, it's not considered a rollover. There's no limit on the number of these types of transfers, and they're not reported on a Form 1099-SA, a Form 1040, or a Form 8889. Death of an HSA account holder. Quite simply, if the beneficiary is a surviving spouse, the HSA is treated as the surviving spouse's account. We'd complete a Form 8889 as normal. If the beneficiary is not the surviving spouse, then it's out of scope for Tax-Aide. It's out of scope for us. Just another reminder that the last slide of this presentation contains a link to a Tax-Aide video that covers the entry of HSA information into TaxLayer. It's a really good video. Now in TaxLayer, we'll enter HSA information into the data entry area for Form 8889. We saw earlier that contributions are entered into Part 1 of this form. Distributions are entered into Part 2, shown here. Now please note, if any information winds up in Part 3 of Form 8889, the return is out of scope. And a knowledge check on distributions from an HSA. True or false? Liam established an HSA in July. He incurred medical expenses in May and wants to pay for them from his HSA, these expenses are qualified. So can Liam pay for medical expenses that he incurred in May? Number 2, Ingrid has an HSA and a self-only HDHP. She can use her HSA to pay qualified medical expenses for which of the following? Her spouse, her dependent children, her cousin who doesn't live with her, her dad who could be a dependent except his income is too high. And the first answer is false. Only expenses incurred after the account was opened are qualified. And for question 2, she can use her HSA as Ingrid to pay qualified medical expenses for which of the following? For her spouse, that's a yes. Her dependent children, that's a yes. Her cousin who doesn't live with her, that's no, because the cousin couldn't be a dependent. Or her dad, who could be a dependent, except his income's too high. And the answer for that is yes as well. And 2 final questions that deal with distributions from an HSA. True or false? Anna was eligible for and opened an HSA in 2021. She incurred $602 in qualified medical expenses in 2023 and will not deduct those expenses in 2023 on Schedule A. If Anna takes a $602 distribution from her HSA to cover these expenses, the reimbursement will be non-taxable. And finally, which of the following are considered HSA qualified medical expenses? Over-the-counter cold medication without a prescription, cosmetic surgery, medical marijuana, and COBRA coverage. So the answer number 1 is true. Anna was eligible for and opened an HSA in 2021. She incurred the $602 in qualified medical expenses after her HSA was opened, which was in 2023 when she incurred the medical expenses. And since she's not deducting those on Schedule A as medical expenses, then she can claim them. It's true. Which of the following are considered HSA qualified medical expenses? We covered this earlier. Over-the-counter cold medication without a prescription? That's a yes. Cosmetic surgery? That's elective. That's no. Medical marijuana? Well, marijuana is still illegal at the federal level, so that's a no. And COBRA coverage? That's a yes. Now, there are HSAs, health savings accounts. There's also something called a flexible spending account, or an FSA. Now, both of these help save to pay qualified medical expenses, but an HSA allows a carry forward of funds and investment unlimited in terms of time. An FSA, there's no or limited carryover of funds. You use it or you lose it. And one comment, you can't have a healthcare HSA and a healthcare FSA at the same time. Now, there is something called a limited FSA, which can be had at the same time, held at the same time as an HSA, but that's a limited one. When we're talking about a normal flexible spending account, you can't have a healthcare one at the same time as a health savings account. So for an HSA, what are out of scope for us? Excess contributions to an HSA that are not withdrawn in a timely fashion. We covered this. That would incur an extra 6% tax. If there is a tax, it's out of scope for us. Contributions by an ineligible taxpayer. That'd be a situation where a taxpayer maybe is not eligible, but opens an HSA and contributes to it. And the death of an HSA holder when the surviving spouse is not the beneficiary. Important things to know about HSAs. The distributions are not taxable when offset with unreimbursed qualified medical expenses. An HSA remains with the taxpayer. It's portable. So even if they change employers or they retire, the HSA remains with them. Now, contributions remain in the account until used. There's no time limit to use the funds. The owner doesn't have to be eligible in the year of the distribution. There are no joint accounts, even if they're married. Two Form 8889s must be generated if they both have HSAs. And any contributions or distributions for the year, a taxpayer would need to file a tax return. Don't worry though, all the calculations are performed by TaxSlayer. I mentioned a couple of times during this presentation that everything you need to know about entering HSA information is contained in the NTTC video that can be found at the address that's listed on this slide. It's 11.5 minutes long, but it covers all HSA situations we normally see. And this is where we'd normally pause for questions and comments.